The US Treasury is the most heavily traded security on Earth. Settling one takes 2 business days, and an entire industry exists to manage those 2 days. On May 7th, the same banks that profit from those 2 days settled one in 5 seconds. On purpose. No DTCC, no clearinghouse. 2 banks, cross-border, after hours, on a public blockchain. 2 days of machinery, replaced by 5 seconds, built by the people it puts out of work. 4 names were on this trade: Ondo Finance, JPMorgan's Kinexys, Ripple, Mastercard. The asset was OUSG, Ondo's tokenized short-term US Treasury fund. Ripple held a position in OUSG. Ripple redeemed it. The asset leg moved on the XRP Ledger and settled in under 5 seconds. Mastercard's multi-token network routed the instructions. JPMorgan's Kinexys delivered the dollars to Ripple's account in Singapore. Cross-border, cross-bank, outside business hours. A trade that normally takes 1 to 3 business days through correspondent banks, settled in 5 seconds. Ondo framed it as the groundwork for 24/7 global markets that never close. Translate the marketing. A US Treasury, the most heavily traded instrument on Earth, now has a 24/7 settlement layer. The old rails worked 9 to 4, Monday through Friday, in the relevant time zones. The new rails run whenever the wallet wants to redeem. Bloomberg covered the trade. Almost nobody outside the crypto-native press understood what it meant. Treasury settlement has 2 legs. The asset leg moves the security. The fiat leg moves the cash. In the legacy system, those 2 legs ride different infrastructure. The asset leg runs through DTCC. The fiat leg runs through Fedwire, or correspondent banking. The legs are reconciled at end of day, sometimes end of week. Between leg 1 and leg 2, you have settlement risk. That is the entire reason T+2 exists. 2 days of buffer to make sure both sides clear. Atomic settlement collapses both legs onto one ledger. The asset and the cash either both clear or neither clears. Same transaction, same ledger. No reconciliation, no risk window. The Ondo JPMorgan trade did exactly that. OUSG as the on-chain asset, Kinexys as the on-chain cash. Atomic, 5 seconds. The XRP Ledger as the venue is the part most observers missed. Ripple chose it because it has 3 things institutions need. It can issue assets directly on the ledger, it settles with finality in seconds, and it has a compliance framework banks can actually deploy on. Ethereum could not have done this trade at this latency on its base layer today. Solana could, technically, but the institutional compliance plumbing is still being built. Stellar could, and on May 27th, DTCC picked Stellar for its own tokenization service, for the same reasons. The chain choice signals something specific. Ripple, Ondo, JPMorgan, and Mastercard chose XRPL because the trade had to finish in seconds, not minutes. The chain follows the trade. The trade does not follow the chain. Take that mechanism and follow the money it unlocks. Today, every treasury trade has a carrying cost. The seller is short the asset for 1 to 3 days, while the buyer is short the cash. Both parties price that carrying cost. That cost is the foundation of repo markets, of the Federal Reserve's reverse repo facility, of how prime brokerages provide overnight funding to hedge funds. Repo is the plumbing of short-term funding. Sell a treasury tonight, agree to buy it back tomorrow, and you have borrowed cash overnight against it. The whole market runs on the assumption that settlement takes time. The entire short-term funding architecture of US capital markets is priced off that assumption. When settlement takes seconds, the assumption collapses. The carrying cost goes to 0. The need for intraday liquidity facilities shrinks. The repo desk's reason to exist gets called into question. The Office of Financial Research sizes the US repo market at about $12.6 trillion in daily exposures. Nearly 70% of it is collateralized by treasuries. That entire market is, in part, an inefficiency tax on slow settlement. Atomic settled tokenization is a direct attack on that tax. Picture a repo trader at a mid-size fund. She reads the headline and does the math. If a treasury can settle in 5 seconds, why is she paying 8 basis points, a fraction of a percent, to a custodian to hold it overnight? Why pay a prime brokerage to fund an overnight position she no longer needs to carry? That is the question this settlement asks. Wall Street has not answered it yet. 3 constituencies should be paying attention. 1. The big custody banks. Bank of New York Mellon and State Street, between them, hold over $70 trillion in assets under custody, per their own disclosures. Their fee structure assumes a friction layer between asset ownership and asset movement. Atomic settlement compresses that friction layer. The custody business does not go to zero, but the margin model changes fundamentally. 2. DTCC's clearing franchise. DTCC clears the entire U.S. equity market through a settlement infrastructure built in the 1970s. The October tokenization launch we covered last week is DTCC trying to get ahead of the disruption. The Ondo JPMorgan trade shows DTCC's own participants going around DTCC on their own. 3. Prime brokerage. Goldman, JPMorgan's own prime division, and Morgan Stanley together provide trillions in overnight funding to hedge funds. That business is priced on the carry created by slow settlement. Goldman's prime brokerage revenue last year was over $4 billion per its annual report. A meaningful share of that is settlement arbitrage adjacent. 3 things to watch in the next 2 quarters. Ondo's pipeline includes a settlement product for tokenized investment-grade corporate bonds. Same mechanism, different asset class. Expect that by Q3. JPMorgan's Kinexys is scaling. The Onyx to Kinexys rebrand earlier this year was the corporate signal that JPMorgan intends to compete with Ethereum and Solana on its own institutional infrastructure. Ripple is building a regulated stablecoin to plug into XRPL settlement, alongside the Kinexys cash leg that already exists. By Q4, expect at least 2 institutional-grade cash on XRPL options for atomic settlement. The infrastructure for what the SEC paused last week is already shipping. Different stack, different partners. The pause did not stop the build. If you're issuing a tokenized asset, 3 decisions used to define the work. Onshore or offshore? Real share or wrapper? Whose registration to ride? This trade rewrote all 3. 1. The binary is no longer onshore or offshore. The binary is permissioned blockchain or public blockchain. Kinexys is permissioned. The XRP Ledger is public. The trade went on the public one. 2. Real share or wrapper got a 3rd option. Tokenized fund share. OUSG is not a real share. It is not a synthetic wrapper. It is a token representing your slice of a registered fund. Path of least resistance for institutional rollout. 3. Whose registration is no longer the question. The question is, whose settlement do you trust? DTCC, Kinexys, the XRP Ledger, Stellar. The chain choice is the registration choice now. If you are building any of this, the contract layer is the easy part now. Roll your own with OpenZeppelin's audited templates, or skip the wiring entirely. Bitbond's token tool deploys mintable, burnable, pausable contracts across EVM, Solana, and Stellar in one step. The hard part is whose settlement you trust and whose cash you accept. 5 seconds for a treasury. The rails do not wait.